The value of the US dollar fluctuates constantly. These fluctuations can be categorized as either devaluation or depreciation. Devaluation is a deliberate policy action taken by a government to reduce the value of its currency. This is usually done to make exports cheaper and imports more expensive, potentially boosting domestic production. Depreciation, on the other hand, is a natural market fluctuation caused by factors like supply and demand, economic performance, and interest rates. While both result in a weaker currency, understanding the distinction is crucial. Devaluation, being a policy decision, sends a strong signal to the market and can significantly impact investor confidence. It can be perceived as a sign of economic weakness or instability. Depreciation, however, is a more gradual and organic process, often reflecting underlying economic fundamentals. The distinction between devaluation and depreciation is not merely academic. It has real-world implications for businesses, investors, and policymakers alike. For instance, a company engaged in international trade would need to factor in the potential impact of both devaluation and depreciation on its bottom line. Similarly, policymakers need to carefully weigh the pros and cons of devaluation as a policy tool. The current debate about the US dollar's future trajectory necessitates a clear understanding of these terms. While some analysts predict a depreciation of the dollar due to various economic factors, others speculate about the possibility of a deliberate devaluation by the US government. The ramifications of either scenario are far-reaching and will undoubtedly shape the global economic landscape in the years to come. Former President Donald Trump has repeatedly expressed his preference for a weaker US dollar. He believes that a weaker dollar would make American exports more competitive in the global market and reduce the trade deficit. This stance has fueled speculation about potential actions his administration might take to influence the dollar's value. Trump's advisors have reportedly considered various strategies, ranging from direct intervention in currency markets to imposing tariffs and engaging in negotiations with other countries. One approach that has been floated is a Plaza Accord-style agreement, similar to the one in the 1980s, where major economies coordinated to devalue the dollar against the Japanese yen. However, replicating such an agreement in today's geopolitical climate, particularly with China's reluctance, is highly unlikely. Despite Trump's desire for a weaker dollar, his administration's policies have often had the opposite effect. Tax cuts and deregulation, while intended to stimulate the economy, have also led to a stronger dollar. This is because these policies can attract foreign investment, increasing demand for the US dollar. The potential for a second Trump administration to actively pursue dollar devaluation remains a topic of debate. On the one hand, Trump's protectionist instincts and desire to reduce the trade deficit might push him towards such a policy. On the other hand, the potential risks and challenges associated with devaluation, such as market instability and global backlash, could make him hesitant. The allure of a strong dollar is undeniable. It signifies confidence in the US economy and attracts foreign investment. A strong dollar makes imports cheaper, benefiting consumers and businesses that rely on foreign goods. However, there's also a flip side to this strength. A strong dollar can hurt American exporters by making their products more expensive and less competitive abroad. It can also lead to trade imbalances and negatively impact emerging markets that have dollar-denominated debt. The Federal Reserve's monetary policy plays a crucial role in influencing the dollar's strength. Interest rate hikes, for example, can attract foreign capital, driving up the dollar's value. But higher interest rates can also slow down economic growth and increase borrowing costs. The interplay between these factors creates a complex landscape that policymakers must navigate carefully. Balancing the benefits and drawbacks of a strong dollar requires a nuanced understanding of both domestic and global economic dynamics. As the world becomes more interconnected, the implications of a strong dollar extend far beyond US borders, affecting economies worldwide. Navigating the devaluation debate involves understanding the risks, implications, and uncertainties. Devaluation can provide short-term economic relief by boosting exports and reducing trade deficits. However, it can also lead to inflation, as imported goods become more expensive. This inflationary pressure can erode purchasing power and negatively impact consumers. Additionally, devaluation can spark retaliatory actions from other countries, leading to trade wars and further economic instability. Investors may lose confidence, causing capital flight and exacerbating financial crises. On the flip side, avoiding devaluation might preserve investor confidence and economic stability, but it could also result in prolonged trade deficits and economic stagnation. Policymakers must weigh these trade-offs carefully, considering both the immediate and long-term effects. The global economic environment adds another layer of complexity, as actions taken by one country can ripple across the world. In this interconnected landscape, collaboration and communication among nations become essential. The future of the US dollar, whether through devaluation or other means, will be shaped by a multitude of factors, each with its own set of risks and rewards. Understanding these dynamics is crucial for making informed decisions in an ever-changing global economy.